Hello and welcome to the macro of it for the end of the week that began on the 28th of August 2017. One and only thing I really want to highlight from this week's numbers, because it was a very quiet week and realistically the main event happens tonight over in the US, but it is actually a piece of data that happened in Australia, and that was the CapEx data that happened on Thursday. They were really interesting. Headline figures, and what might be pointed out is the fact that it is still declining, and that is the future expectations and the current CapEx expenditure. That is not unsurprising. It's been happening basically for 4 years. It's the real fall off a cliff of the mining capital expenditure, which is what you expect. It's what we know. It's what you can see coming out of Western Australia. What was really positive is the future intention spending, and I think that really is what I'll highlight now. Expectations were for 94.2 billion Aussie dollars for calendar year 17 and 18. It came in at 101.2 billion, and that's from a previous figure of 84. That's a really positive thing. Now, normally when you get closer and closer to the expiry date, these things do ramp up, so that needs to be taken with a bit of a pinch of salt. But what was really impressive out of that number is if you have a look at what they classify as other, and that is basically services. There's always been this question around who is going to pick up the slack from the mining boom, and it's always been pointed and fingered to the services industry, but it just hasn't happened. And this is the first real sign, it was a record print as I said, that it's actually coming to fruition. And that should be the case. It should actually back up what we've been seeing in Australian PMI numbers, also in NAB business confidence numbers. They're all moving in a more optimistic view. So therefore you should expect capital expenditure and future capital to be going into the market and into the economy. And that was the first sign of a real sort of sustained and actual concerted effort that their services are picking up. The other part of it is that there are certain parts of it that actually feed into GDP, things like equipment, etc., and they were also really, really strong. And that is again suggesting that maybe the RBA is right, that we could get towards 3% GDP at the end of next year, start of calendar year 19. And that's an interesting part about it as well. So the RBA would have been really happy with the data that came out from CapEx, because it does just reiterate that their forward estimates and their current forecasts are possibly moving in the right signs. There is now more and more green shoot signs that everything is moving. The fly in the ointment is clearly the currency, and we know that. The Aussie dollar is very, very positive, and there are really big signs at the moment that it's going to remain that case. And then wages, and I've been highlighting wages for quite a while, that they are the other major constraint on the inflation side. And don't forget, the RBA's main mandate around rate movements is inflation. But what we saw yesterday will put them in a very good light, and therefore it means that they do have something to really smile about. So that's why yesterday's data was so important, and why a lot of people are highlighting it, that finally, the slack has been picked up.
The essence of robo-advice is using technology and digital services to help members or clients reach their financial goals, and helping you improve your portfolio through diversification. That's investment advice. That's automated investment advice. By using technology and automated services is being able to deliver those services cheaply and affordably. Robo-advice or automated investment services are just the start.